Silver moves first, stress gets admitted later. Welcome to Wheelixon, where history isn't just remembered. When financial stress finally shows up in headlines, most people assume it just appeared. A bank suddenly collapses. Inflation suddenly spikes. Liquidity suddenly disappears. But applied financial history shows something far more unsettling. Stress is almost never sudden. It builds quietly beneath the surface, long before institutions acknowledge it. And again, one asset reacts before the rest of the system does. Silver. Not because silver predicts the future, but because silver sits where financial promises collide with physical reality. Silver is often misunderstood. Some people treat it like a poor man's gold. Others see it as just another commodity. Traders reduce it to charts and momentum. But historically, silver has played a very specific role. It has been money. It has been an industrial input. When systems stretch too far, silver responds before narratives change. This isn't new. Silver has behaved this way for centuries. In monetary transitions, silver moved before paper collapsed. In inflationary periods, silver reacted before official data admitted pressure. In shortages, silver tightened before governments acknowledged constraints. The reason lies in what silver actually represents. Gold can sit untouched in vaults for decades. It is hoarded, stored, and admired. Silver is consumed. It disappears into electronics, medical equipment, energy infrastructure, defense systems, and industry. Once used, much of it is never economically recovered. That makes silver different. It cannot lie for long. Modern financial systems rely heavily on abstraction, derivatives, futures contracts, ETFs. These instruments work as long as belief holds, as long as participants trust that paper and reality remain interchangeable. Silver is where that assumption gets tested. For decades, silver markets functioned smoothly because physical supply acted as a buffer. If demand increased, inventory filled the gap. If prices dipped, metal reappeared. This buffer allowed paper markets to dominate price discovery. But applied financial history shows buffers are finite. When buffers thin, price stops behaving politely, not explosively at first. This is where silver starts to move, not because people suddenly become bullish, but because physical demand stops responding to price signals. They don't wait for pullbacks. They don't speculate. They buy because production schedules demand it. That demand is inelastic, and inelastic demand exposes stress faster than any headline. Financial systems don't like early signals. Early signals create uncomfortable questions. Are inventories sufficient? Are paper claims credible? Is price discovery still accurate? So early signals are often dismissed. Noise. In the 1960s, gold began draining from official reserves under the Bretton Woods system. Prices were fixed. Confidence was publicly reinforced. Privately, stress was mounting. Gold moved first. The system admitted stress later. Silver behaved similarly during periods of inflationary pressure in the 1970s. Before CPI exploded, before confidence cracked, silver tightened. Not as prophecy, as reflection. This pattern repeated in modern times. Before 2008, commodities began signaling stress while financial narratives remained calm. Housing was contained. Risk was diversified. Liquidity was abundant. Silver did not respect those words. It reacted to physical realities. Rising costs, the system admitted, stress only after failure forced it. Why does this keep happening? Because silver operates at the intersection of two worlds, the world of financial belief and the world of physical constraint. Most assets live in one or the other. Silver lives in both. That makes it uncomfortable. Modern financial systems prefer assets that can be managed. Stocks can be supported. Bonds can be stabilized. Currencies can be defended. Silver cannot be printed. It must be mined, processed, delivered. That introduces friction. When paper-silver markets dominate, stress stays hidden. But when physical demand tightens, settlement confidence matters. Applied financial history teaches us that markets don't fail when prices rise. They fail when delivery becomes uncertain. Price volatility is survivable. Uncertainty is not. This is why divergence matters. When regional prices drift apart, trust is fragmenting. These aren't trading anomalies, they are system signals. Financial narratives respond slowly to these signals, because acknowledging them too early destabilizes confidence, so language becomes careful. Localized shortages, temporary bottlenecks, seasonal demand. These phrases aren't lies, they are stabilizers. Applied financial history shows that systems rarely deny reality outright. They delay it, they soften it, they rename it. Silver's role is not to announce collapse. It never has. Its role is to reflect pressure when the system prefers calm. The problem for modern systems is that thermometers don't care about narratives. They respond to temperature. When stress rises, silver reacts. Refusal is what draws attention. Notice how often silver moves while officials reassure. This is not coincidence. Officials speak to confidence. Silver responds to constraint. These are different audiences. People expect silver to behave like a stock. They expect rallies and crashes. But silver's most important movements are not dramatic. They are persistent. Unwillingness to fall, resistance to suppression. These behaviors signal something deeper. Applied financial history teaches that early signals are always unpopular. They challenge comfortable assumptions. Before stress is admitted, those pointing to signals are dismissed. Later, they are called obvious. This happened with inflation. Commodity prices rose before official inflation metrics acknowledged pressure. Energy moved. Inflation was transitory until it wasn't. Before stress appears in bank balance sheets, funding markets tighten. Before funding markets tighten publicly, collateral quality becomes critical. Before collateral issues appear, physical assets with delivery constraints react. Silver sits there. This does not mean silver is always right. It means silver reacts early. Early signals are messy. They lack confirmation. They are easy to dismiss. Financial institutions are incentivized to maintain calm. Admitting stress too early risks self-fulfilling panic. So they wait for certainty. Silver does not wait. This difference in timing creates the illusion that silver is ahead. In reality, it is simply responding to reality before narratives adapt. Another reason silver moves first is inventory opacity. Unlike currencies or bonds, silver inventories are fragmented. No single authority controls the full picture. This makes silver difficult to manage centrally, and difficult systems reveal stress earlier. History shows that assets hardest to manage send signals first. Energy, food, metals. Silver is unique because it straddles monetary history and industrial necessity. That dual role amplifies its sensitivity. When systems are healthy, silver behaves quietly. When systems stretch, silver becomes restless. This restlessness is what confuses observers. They look for news. They look for catalysts. They look for villains. But applied financial history shows stress doesn't need a villain. It emerges from imbalance. The imbalance today is not unique. Promises exceed resources. This does not guarantee collapse. It guarantees adjustment. Adjustment can be slow. It can be managed. It can be painful without being dramatic. Silver does not care which path is chosen. It responds to pressure regardless. Stars nice. Understanding this changes how silver should be viewed. Not as a lottery ticket, not as a price target, not as a get-rich-quick asset. Applied financial history is about reading signals, not chasing outcomes. It asks different questions. Not how high will silver go, but why is silver behaving this way now? That question reveals more than any forecast. When silver moves first, it is not shouting, it is whispering, and whispers are easy to ignore until they are. This is why stress always appears suddenly in hindsight. The signals were present, they were just inconvenient. Financial systems prefer comfort over early correction. Silver prefers honesty. That mismatch explains its behavior. Understanding this does not require believing in collapse. It requires recognizing timing. Systems admit stress only when they must. This is why silver always seems early. Once stress is admitted, silver's role changes. By then, the opportunity to understand early has passed. Applied financial history is not about panic. It teaches us that truth emerges in stages. That is why silver moves first, but because it cannot pretend the present is comfortable. If you want to understand money beyond headlines, subscribe to Wheelixen.